So, Aunt Gertrude just passed away, and she left you and your 3 other siblings her IRA.
What? When did this happen? You're joking, right? That's not funny!
She's named her trust as the beneficiary. Your eyes light up because you could welcome an inheritance, but there's someone else who's waiting to get their hands on Aunt Gertrude's money as well, and that's Uncle Sam.
All right, now if you'll just give Uncle Sam your autograph here.
Sammy, get well soon.
Now picture the inheritance as a pie, and each of you are supposed to get equal amounts of that pie, but Uncle Sam takes 1/3 of it even before it's split between the 4 of you.
You know what? Now I want some pie, Kay. I want some pie. Let's go get some dumbass pie.
Now, there's less pie to go around. But how would you like to give Uncle Sam less pie?
I'm all ears.
I think we're all in favor of that. Having a trust as a beneficiary is a good thing when you plan on splitting your assets between multiple beneficiaries. And it's better than having no beneficiary at all. But is naming your trust the best way to transfer assets to your loved ones on your death?
Wow, that's a great question.
We'll explore that in a few moments. A traditional IRA is treated different than other accounts when it comes to receiving distributions. If Aunt Gertrude was over 72 years old and was receiving her required minimum distributions, then the beneficiaries must continue to take those distributions. RMDs are required for IRA owners over 72, and it's the minimum amount that the IRS requires someone to take out of their IRA in a year so that money can be taxed. If the trust is the beneficiary, most likely the trustee will elect to cash out the entire IRA and have the trust pay the tax on that entire amount. For small IRAs, this usually isn't too big of an issue. But what if the account was a substantial amount? What then? Trusts are taxed differently than individuals, and the tax brackets are much higher for the trusts. For example, if taxable income of $100,000 for someone who's married, filing jointly, would place them in the 22% tax bracket, whereas a trust would be taxed at 37%. In this instance, it would have been better to name each individual as a beneficiary and have their income taxed at their tax bracket rather than the trust tax bracket. Is it too late now that Aunt Gertrude has died and can't change anything?
I have no idea.
No, it might not be too late. It is possible that the financial company holding the account will allow you to do what's called a see-through trust. In order for a trust to qualify as see-through, it must meet 4 criteria. Number 1, the trust must be valid under state law. This means that it must be not handwritten by the individual and it must be notarized. Most trusts drafted by a estate planning attorney would qualify as valid. Number 2, the trust must become irrevocable upon the death of the IRA owner. Number 3, each beneficiary must be identifiable by the trust. It can't be grouped together as children, grandchildren, nieces or nephews. Their names must be stated as beneficiaries in the trust. Number 4, a copy of the trust must be provided to the IRA custodian by October 31st of the year following the IRA owner's death. So what are the benefits once it's qualifying as a see-through trust? Well, by doing this, those funds will go directly into the beneficiary's IRAs in the beneficiary's name. So using the previous example, if each of them, in this case, would receive $25,000, and then from there they could elect to take out the money whenever they want, as long as it's taken out in those 10 years. By the end of the 10th year, all assets must be distributed from that beneficiary IRA. Depending on the individual's tax bracket, it's most likely that they'll pay less in tax than the trust if it had cashed it out. The best way to keep more delicious pie to yourself is to contact an estate planning attorney, a CPA, or myself, a financial advisor. And together, we can help you enjoy more pie.
Who wants pie? I want pie.
For more information, contact me, Bob Stockoski, at AQuest Wealth, and hit the subscribe button.